Look, if I had 100,000 to invest right now, here's exactly what I would do. Not theory, no guesswork, just a simple strategic breakdown of where I'd put that money and why it matters in this market. So whether you're sitting on 5,000, 10,000, or 100,000 and you're planning your next big move, this is exactly how I would build a portfolio that actually makes sense in 2025. Here's how you should split that 100K right now. NVIDIA, stock number one. This is the best stock to ride for the AI wave. Vanguard Dividend Appreciation ETF. It's boring, steady, and pays you to wait. And third stock here is Brookfield Asset Management. That way you have exposure to real assets that don't get crushed every single time the market takes a dip. Look, obviously this isn't gambling. It's just a simple way to grow your money over time in a way that actually makes sense and isn't complicated. Alright, let's start with stock number one, NVIDIA. We all know NVIDIA builds GPUs, and if you don't, they basically specialize in chips that power gaming, rendering, and now they do the heavy lifting behind artificial intelligence and large data centers. So if you don't know what a GPU is, it is a chip that can handle a ton of calculations all at once, which is exactly what's needed to train AI. Now, think of AI as the big thing everyone's obviously talking about, right? And NVIDIA is basically the company making the tools that keep it running. Their chips are super in demand thanks to the AI buzz and growing data centers around the world. That's why NVIDIA is the growth piece here. The one that's going to turn your returns from decent, from average to amazing over the next decade. The drivers here are very straightforward. There's more AI models. There's more cloud infrastructure. There's broader adoption of machine learning across industries. There's growth in gaming and new uses like autonomous vehicles, which are a thing. Each of those trends increases demands for GPUs, and this is going to give NVIDIA the power to raise its prices and keep growing its revenue. Now, NVIDIA is a beast, right? But let's be honest, it doesn't go up in a straight line forever. Some years it flies, other years it's going to dip. Price is pretty high right now, so it's pretty sensitive to any bad news. Also, you want to keep in mind that there are competitors and things like government rules or world events that could probably shake things up for the stock. So here's how I would handle it. Don't treat NVIDIA like a lottery ticket, right? You want to treat it like something that's powerful but volatile at the same time. Limit your exposure. Always dollar cost average your entries, and you're probably going to have a decent amount of profits. But you want to make sure you also tweak your portfolio now and then to lock in those wins and avoid putting too much in one place. So here's how I'd play it with 100K. For a balanced approach, put about 20 to 30% into NVIDIA. Now, if you're feeling a little more aggressive, I would say go with 40%. And if you want to be a little safer, keep it to around 10 to 15%. Important thing here though is the dollar cost average. Don't just go into your brokerage account and dump all your money into NVIDIA all at once. Break it up into 4 to 6 monthly buys. This is going to help you avoid buying at the wrong time, and it's going to help smooth out the price. Once you have a portfolio, you want to rebalance. If NVIDIA grows more than 35% of your total portfolio, sell some. Get back to your target. If NVIDIA jumps over 50%, which could be a thing, right? Highly likely above your average price, think about selling 10 to 20% of it and maybe moving that into cash or into something more stable like the next stocks I'm going to talk about, VIG or BAM. Now, expect the ups and downs here. You want to mentally prepare for the swings. Don't look at the market every day. If the roller coaster feels a little too weird for you, dial back your NVIDIA allocation. The key here, the key to winning isn't chasing crazy returns. It's never that. It's sticking around for the long haul. Protect your capital. Now, let's balance out that rocket, NVIDIA, and keep things a little more grounded here. We're going to bring in something a little more stable, and this is VIG. VIG just stands for Vanguard Dividend Appreciation ETF. Here's a quick explainer, a quick definition if you don't know what an ETF is. It's basically a basket of stocks you can buy with one stock. So VIG specifically holds companies here that have raised their dividends in the past 10 years or for at least 10 years straight. In plain terms, they're basically reliable at paying you extra cash year after year. And who doesn't like cash? And the reason it fits is because VIG is like a safety net. While Nvidia chases big wins, VIG is going to deliver steady and dependable returns and a stream of dependable income that you can count on. Now, it is made up of solid companies that stick around through tough times. Again, that's going to help smooth out all the market craziness. Now, some growth income drivers of VIG here, the rising dividends, right? When companies are steadily increasing payouts, you're going to get more cash to reinvest each year, which will compound over time. And over the long term, stocks that raise dividends tend to match or beat the market, but without the wild ups and downs. So VIG is going to combine steady growth with good payouts, giving you solid returns without the roller coaster ride. And we're not at Disney World here. I hope that was funny, but I don't think it was. Now, let's be real. Dividends aren't set in stone. Companies can cut or pause them during tough times. Also, VIG's current yield, I believe, a 1.7%. Now, this isn't a high income play, but it is stability, and it's a compounding play. Another headwind here to take into account is rising interest rates can make dividend stocks less attractive compared to things like bonds, which can pressure prices. Now, when investing, you always want to mitigate. What I would do here is reinvest those dividends automatically. I think the term is called drip here. That way you reinvest your dividends and you let your dividends buy you more shares and you stick with it for the long term. Now, if you stay patient and you don't pick stocks just because they pay big payouts or your friend told you about it, chances are pretty high you will succeed. Now, if VIG does fall, it means you're probably going to get strong companies for less. Obviously, if you're still buying, which is usually a really good thing. Now, here are some takeaways, some suggested allocations, say if you have that 100K. Say 30 to 50% depending on your risk tolerance, right? If you're more conservative, that's going to be perfect. Now, dollar cost averaging. You want to invest monthly, whatever you can, right? Per month until you hit your target. Again, this is going to smooth timing risk and keep you disciplined because we can't all time anything, right? And if VIG falls under its target, you want to buy more. Once again, if it runs ahead and exceeds the target by 8 to 10%, trim a little bit and rebalance. So some practical tips: reinvest those dividends automatically and use those payouts to top off Nvidia. That way you can get extra growth exposure and grow that portfolio. Think of VIG as basically the steady part of your portfolio here. It's going to keep things stable while the riskier stuff like Nvidia here does all the heavy lifting. It might feel boring, but it's quietly working hard for you in your favor. So don't have your eyes glued to the stock market or your portfolio. Now, the last part of the portfolio is Brookfield Asset Management. In one line, Brookfield basically is a global manager that owns real physical things like real estate, infrastructure, renewable energy. So you get a piece of the economy without having to buy the building yourself. And the reason it fits and why you should have Brookfield in your portfolio is because real assets, things like buildings and energy projects, they usually keep up with inflation. Inflation is terrible. When prices goes up, things like rents and tolls often go up also. That's going to make companies like Brookfield here a good way to protect your portfolio from things like inflation while balancing out tech stocks and the dividend stocks in your portfolio. And here's why it matters. Governments and companies are always investing heavily in infrastructure and clean energy. And Brookfield, they manage over $1 trillion in assets globally. Things like highways, ports, wind farms, and data centers. These assets bring in steady money and have long-term contracts, so they can keep paying and growing as the world upgrades its infrastructure. Now, there are some risks with Brookfield. There's risks with everything. Since they borrow to buy properties, higher interest rates can cut into their profits. And office buildings have been a challenge since remote work became more common and more of a thing. Plus, Brookfield's stock price here can drop a lot during market sell-offs, even if the actual assets itself is still doing fine. Hope that makes sense. So the way I treat Brookfield here is like your safety net. It's not a wild bet. Limit how much you put into it. You want to obviously expect short-term volatility, but plan for long-term income and capital appreciation. If markets do panic and Brookfield dips, that can be a good opportunity to buy more, especially at an attractive price, as long as the business is still strong and it still makes sense. Now, some takeaways here: put about 20 to 30% of your 100K into Brookfield. If you want more safety, you can go a little higher. If you're chasing big tech growth, obviously you want to go a little lower. Now, I would buy a little at a time, just like everything else. Maybe a couple thousand here every quarter. That way you could avoid buying all at once and risking bad timing. And then obviously we want to rebalance If Brookfield grows more than 35% of your portfolio, you want to sell some. Now, if Brookfield does drop, only buy more if the business is still doing well and makes sense and is making good money. Now, don't throw cash at companies that are struggling. And a pro tip here is Brookfield's assets, they usually make more money over time. So you want to reinvest those dividends, and that's going to help your portfolio grow at a much faster rate. And the cool thing is why these three work. Here's where the real strategy shows up with this mix. Alone, each of these stocks here that we pick, they can blow up your portfolio in a good way or a bad way. But together, they're going to act like a team. One's going to push for big gains, one steadies the ride, and one protects your purchasing power. That mix is exactly what makes this plan strong and reliable. NVIDIA is the engine here. When AI and data centers are booming and everyone can't seem to get enough, it's going to deliver massive returns. But heads up, it's a wild ride with big ups and downs. VIG, this is the income here. This is Mr. Smooth Operator. It's going to hand you rising dividends and more steady returns. When markets do freak out, dividend stocks like VIG, they usually don't fall as much. And if they do, they bounce back much quicker. And finally, we have the hedge, Brookfield here. This is your safety net. It owns real things like rent, tolls, and energy contracts. It might even own your home. Now, when prices do rise, it's a good thing. It's going to help protect your buying power. Now, here's an analogy here, just to keep it simple and a simple way to think of it. Imagine all three of these like a three-legged table. If one leg gets a little too short, the other two are going to keep it steady. That's diversification working its magic. Now, here are three clean model splits for that 100K portfolio, depending on your risk tolerance, right? If you're conservative, I'll do NVIDIA about 10%, VIG about 50%, and Brookfield about 40%. That way you prioritize safety and income. Now, if you're balanced, it's going to be 25%, 40%, and about 35% with Brookfield. That way you get meaningful growth with strong protection. And if you're aggressive like me, about 40%, 30%, and 30%. That way you're going to have higher upside, but with safety cushions still in place. Now, once you have your mix, the key here is to keep things boring and consistent. Check your portfolio once a year, twice a year, and if any holdings move more than 10% away from your target, tweak it back a little bit. If one position ever gets too big, say maybe over 35%, sell the extra and put that money into cash or put it into smaller parts. No dramatic moves, no trying to guess the market. It's just simple rules to keep you calm and collective. Now, here's the truth, right? The best portfolio, it isn't the flashiest one. It is the one you can stick with. The one that still has money in it. This trio gives you upside, cash flow, and protection. That's how you survive the bad years and you benefit from the good years. If there's one big takeaway from this video, it's this: balance wins. NVIDIA is your growth. That's going to boost your portfolio over time. VIG is going to offer you steady income, and it's going to smooth out the bumps with dividend-paying companies. And Brookfield here adds real assets to protect your money from inflation. And together, they cover all the bases: growth, income, and protection. Don't overthink getting started. Even putting in $50, $100, $500 today, and setting up an automatic plan beats waiting for the perfect moment. That moment might never come. Small, consistent steps add up big over time. Here's the deal: building wealth in the stock market comes down to just having a simple plan, a reliable plan, and not chasing trends or not chasing the next big thing. Stick to your rules, keep your emotions in check, dollar cost average, and that's going to help you avoid bad timing. Rebalance. Instead of putting all your money in one basket, spread it out. Anyways, what I would do now is pick a style: conservative, balanced, or aggressive, and make a move. Start with VIG for that steady income, throw a couple hundred, what you have, into it. Ladder into NVIDIA for growth, and add Brookfield over time. That way you have inflation protection. And then check it once a year, twice a year, and adjust as your life changes. And remember, at the end of the day, this is a marathon. It's not a sprint. Consistent small steps will add up over time. That way you'll have a straightforward blueprint to growth, income, and protection. Stick with it, tweak it, and when needed, let time do the work. That's how the real progress is made. Now, if you want to go a little deeper, watch my next video here, or my last video. If I could buy one stock for the next 10 years, what stock would it be? And that's Microsoft. Anyways, thanks for making it to the end of the video. Smash that like button for me, subscribe, drop a comment on, maybe a stock that you're looking at or a pick that you think is good. Anyways, if you made it to the end of this video, once again, I do appreciate you, and I'll catch you guys on the next one.